Hello, this is a Chartprofit video. We're approaching 4 hours into the trading day on Friday the 18th of March. This is from the pre-open today. Looking at the E-mini S&P. See there's plenty of buying activity here, aggressive buying here and here on Wednesday, here again on Thursday. There's been no significant selling marked for 13 days, and I said pre-open on Wednesday here until we see significant selling marked. I assume buyers are still in control, and in the longer term, as long as the E-mini holds above 1956.90, that's the half range off last year's high, it's in a strong price location. This week we can see on Wednesday here, when the buyers were active, the value area was higher and wider. As the E-mini made a new high for this rally, and again on Thursday a higher value area. So as I said, pre-open today, buyers are still in control. From the distribution analysis, I thought that the level up around mid 2040s might attract some selling reaction. I said here that first hour post open today, I'll be interested to see if sellers respond at that level. But failing that, and with buyers active and effective so far this week, I would look for a strong close to the week. We're approaching 4 hours into the trading day. We have the E-mini printing here at a new high. So we've seen no, thus far, seller reaction. I think quite likely a strong end to this week. In the longer term now, I would say that this 30-day point of control at 1990, which is our first level support, quick look at the four major stock index ETFs. This is the Spider. Saw the high or low at that major halfway point there. So at the time, it's often a strong pattern. We've come strongly higher from that point. So Spider in a strong price location. As I've mentioned previously, just looking at the technicals here, price oscillator, this indicator here, did turn down at this point. So there is a bit of a negative divergence going on with that indicator. So we have price coming higher and the price momentum slowing slightly. This has a habit of getting back to the zero line once it's turned down, and we can see above here the RSI at the top, above 65, approaching overbought levels. But as I mentioned previously, I would want to see some red, some significant selling marked on the profile before assuming weakness on any time frame. So here's the pulse chart since the middle of February, when we entered a period where more green appeared both on the price momentum and on the breadth in the middle here. You can see just prior to that we did see some significant buying, and that would be the first clue of weakness. We'd see some red coming in up here. So all of this looks pretty solid at the moment. Just going to remind you where the green here comes from. That gets pulled in from these two indicators here on the breadth chart, the daily breadth chart. Again, there's some slight divergences here. Certainly this, the percentage of stocks greater than the 50-day moving average, really high number here, almost 90 for New York. And on the net volume percent 10-day moving average, there's a little bit of divergence going on here. So there's a possibility of short-term weakness maybe going into next week. But again, I'll make no assumptions until we see some red appearing on here, up here. This is the Russell 2000 ETF, IWM. Looks like we see a good end to the week here, possibly a new high for this rally. First level of resistance, which may cause a problem, is the half range off last year's high, which is just above there, which is roughly 111.50 on this chart. And we spoke last week about this doubly important level here on the Qs at 105.13, which is now the major point of control, and the half range off this high last year to this low. So price back below here, maybe the first indication chart wise of weakness if we see price printing time back down here, but this week certainly we've held that level. UK FTSE 100, which is closed fairly strong, not a convincing breakout of this consolidation. The important thing is though, this week it's held its 12-month point of control at 61.08. There is resistance up here a little higher, just above 6,300. Price up here would put the FTSE in a really strong price location, but not too worried. at the strength in this index as long as we hold that level there. Similar situation for the German DAX, again relatively to the US indices like the diamonds, the spider. We're still struggling within this sort of little consolidation area here with no clear breakout, but again, as long as we hold 96.65, which is the major, it's in a pretty strong price location. Looking at the supporting charts, we're looking here at TLT, the T-bond ETF. All of this price action here has taken place above the halfway point of last year's high, so all of this is in a strong price location. And we're currently holding above the minor point of control at 128.43, the 3-month. Noted that the chart got pretty overbought over here on the weeklies, but as long as it holds this level, it's okay. Price down here below 126.50 would be weak price location and indicate lower. Price is going to rally, bonds are going to rally. I would expect that level to hold 126.50, which is the halfway point. In a way, it's the same thing for GLD. On the weeklies, it got overbought, but as long as it holds above 115.50, which is its major here, that was a migration earlier in February, so an important level to monitor. Price back underneath that would indicate lower, but currently all of this consolidation above that point of control, and that's strong. One thing we know about a chart coming off a major low is that the halfway point from that low to the subsequent high of the rally is an important level to watch. So if we do see a retracement in oil, which I'm sure we will at some point, we will monitor the halfway point of that retracement of that rally. But currently, as long as USO, the oil fund ETFs, holds above its 5-month at, actually it's 9 dead here, this level here, it's a strong chart. So for instance, if oil saw some weakness going into next week from this high today, we'd be monitoring this halfway point. Dollar index has not had a good week. It looks to be closing close to this week's lows, which was yesterday, possibly earlier today. The main thing is we're printing below the 2-year at 97.40 and below this halfway point here. And unless that controlling price migrates, maybe lower somewhere here, I just assume weakness until we get back up here. And not surprisingly, the Euro FX chart has moved into a stronger price location in the longer term, holding above its 12-month point of control down here. But also this half range here, we've had just a minor higher low and support earlier in the week at that level. And so I assume strength until we see price back down here, below one spot, 0.925. The pound is holding above its 4-month, which has emerged here. One spot 42.60, and as long as it holds that level, I assume at least short-term strength. In the much longer time frame, it's in a weaker position relative to the dollar than a lot of charts, but have no clear resistance on this chart until we get up to the half range of the 2009 low, which is much higher. So it would be priced back below that 4-month that would put the chart back in a weak price location and suggest a retest, but currently it's pretty strong. When the Aussie dollar held above its 1 year, this was a level that migrated to this point, spot 71.88, suggested we might see a retest of this major level up here at spot 76.50, and as you can see, that's happened at the end of this week. I think this is a big test for this chart. If we see price above that level and printing time, that would suggest further strength. That would be interesting for gold as well. I'm going to look at the sentiment indicators. See, here's the live chart of the VIX. We are printing here below 15 at the end of this week. Is this complacency creeping in on this indicator? If we see if we see the index printing down below 13, that would be its lowest level since August last year. And if I overlay the spider, you can see that was the point here where the spider above here began its swift decline. But we had a very different situation at that point with regards to other sentiment indicators. We had my version of the RIDEX assets ratio off its highs but still above 10, pretty elevated, and you can see here that right now over here we have my version of the RIDEX assets ratio pretty somewhere between 3 and 4. And I don't make any apologies for keep talking about this because I think it's an interesting point to make. The lowest level that we've seen since July 2013 was here in February, just close to the market low here, and you can see how the S&P has rallied, but the response from the retail traders, Ridex retail traders, has been muted to say the least. They clearly do not buy the idea of this rally at all at the moment. And that, as we know, as a contrarian indicator, is usually pretty bullish. It certainly has been coming up off that February low. Again, I'll show you these charts just to update them. We've seen them for the last few weeks. Just showing the bull fund assets that I follow in isolation here. Blue shaded areas show us where the assets were at relatively very low levels in the bull funds, and again, from a contrarian point of view, suggest extreme bearishness and therefore quite bullish for the market. We are up a little bit on the bull funds. Here's the bear fund assets in isolation. Again, in early February over here, reached their highest level since November 2011. Again, an indication of extreme bearishness. That indicator came quite a bit lower, so we saw assets moving out of the bear funds as the market rallied. But this week, interestingly, again, the S&P has rallied, and there's been a little bit of a rally here in the assets in the bear funds. So just to say, certainly in this indicator, nothing here pointing to over-enthusiasm for this rally. Okay, this is the public poll from AAII. The bulls percentage here, down from previous weeks, 37.4 to 30. That's quite a drop in the bulls percentage. So again, this indicator is showing less bullishness than it did a week ago, even as the market has rallied again. And as you can see here, the bears percent was higher at 26.9. Okay, a little different in the investors' intelligence poll. The bulls percentage here was higher at 44.4%. That's up from 39.4. Correspondingly, the bears percent was lower at 30.3. So this poll showing more bullishness, but you can see on the chart here and the indicators below, nothing really to concern us. Again, nothing really to concern us in this indicator, which is the exposure index, which shows current equity exposure of active money managers. That's up actually this week at 62.72. That's a 14-week high. As I've said many times, this indicator tends to provide much better contrarian indications at market lows than it does on the highs. And if we look finally here at the data from Lipper US fund flows this week, they reported equity fund, including ETF, outflows again of a negative 2.1 billion. And over the last 11 weeks, that's the 10th net weekly outflow. We had an inflow actually the previous week, 1 week ago, but this week again another reasonably large outflow. So I'd say on balance, sentiment still indicates plenty of bears. Okay, that concludes this week's summary. Once again, I wish you a good weekend and thank you for watching.